The evidence is out. Women investors are as successful as their male counterparts, if not more so. So rather than going to listen to some male blab on how to be a successful investor, I went straight to the top female investors to find out how they did it. Watch this video to find out what I learned about becoming a successful investor. Hi there, welcome to my channel. Let's talk money and getting more of it. Now, you often hear the names of the most successful or infamous male investors. I'm sure you've heard of the Wolf of Wall Street. But how often have you heard about successful female investors? Anyone heard of the Witch of Wall Street? Her nickname conjures up some evil money-grabbing hag. Not quite the same as the cinematic names given to her male counterparts. And that is likely to be why you haven't heard of any female investors, because a skilled female investor is seen as something of an outlier or something unusual. Finance and investing is largely a male-dominated industry. So many people assume that men are better investors. And recent research has totally rejected this. The findings indicate that although women still currently invest less than men in the stock market, when we do, we perform better in our portfolios by at least 0.4%. So clearly, women are at least equally as skilled as men when it comes to investing. And there are certainly some key principles that top women investors have followed to be successful. And we can implement this into our own investing approach. So let's take a look at what they are. The first principle is time in the market versus timing the market. The best day to start investing was yesterday, and the second best day is today. So says Sally Korshak, the CEO and co-founder of Ellevest, a digital financial advisor for women. And research had proven this is very true. It is very difficult for even a seasoned trader to time the market. So if investing isn't your day job, you're unlikely to have more success at it. But really, does timing matter? Peter Lynch, considered one of the all-time best fund managers, did an analysis to see whether it really made a difference to enter the market at the best time, i.e. when the market's at an absolute low, or at a less advantageous time, like when the market is very high, as it is now in 2020, and he assessed these returns over a 30-year period. And what he found was whether you'd enter the market at the best time or the worst time, your returns only differed by 1%. However, if you had not entered the market at all, you would have missed out on an average annual return of 10.8%. Principle 2 is diversification. Different stocks, different geographies, and even different asset classes. This is the concept of not putting all your eggs into one basket. The purpose is to ensure that you get the highest return at a given level of risk. So basically, by investing in different assets and even different geographies, you want to diversify the reaction of your portfolio to a particular event, because the assets or the geographies may react differently to the event. In some cases, some of the assets or geographies may not even react to the event. And you do this so that you can reduce the risk of your entire return dropping when that event happens. The simplest and easiest way to do this is through an index tracker fund, which is a type of a mutual fund or an exchange traded fund, which has an underlying portfolio built to match an index. And the index could be the S&P 500, the FTSE 100, or a number of other indexes, or a combination of them. So by investing in an index tracker, you're able to get exposure to a large number of assets or different financial assets at a low cost. Principle 3 is to know your goal and your time horizon to reach your goal. Goals are one of the most important aspects of successful investing. Your goals drive your time horizon and the types of investments that are going to be the most successful for getting you the outcome you want. For shorter time horizons, which are usually less than 5 years, lower risk, More liquid investments such as higher interest savings accounts and certificates of deposit are likely to be more suitable, as they will not expose your investments to the volatility of the market and potentially result in the market being at a low point exactly when you want to exit. Longer term horizons, which are generally greater than 5 years, may provide enough time for your investment to grow through compounding and ride out the ups and downs of the market. So the longer you have, the more ability your portfolio has to reach a positive outcome, given how the market goes up and down all the time. Principle number 4 is to know your risk tolerance and to prepare for bear markets. Now, many studies have been performed to analyze whether women have a lower risk tolerance than men, and an equal number of theories have been derived. And my thinking on this is it's pretty much largely irrelevant, and it's based on such a large number of generalizations. The real only study that is important is the one that you do to determine your own level of risk tolerance, because it's the one that counts when it comes to what you want to invest in. It is easy to assume a high risk tolerance when the market is all rosy. I mean, we all do that. Oh, I can withstand a drop in the market when the market's doing pretty well. But humans are pre-programmed to feel losses way more than we ever feel gains. This means we would suffer a greater deal of pain of losing 100 than we would of joy of gaining 100. So you want to have sufficient level of comfort not to withdraw your money and do the wrong things in the market when you're panicking when it's dropping. And that would mean resulting in you crystallizing a great big loss that potentially could have recovered over time. So be very clear where you are on the risk scale and invest accordingly. In addition, before you invest, make sure that you have your security blankets in place. Your emergency fund and any kind of insurances such as income protection or disability insurance to cover you in case you do lose income. You have to remember, and it's very important, that the money you put in the market should be money that you aren't going to need. So be very sure before investing that you're only investing money that you have available to invest. Principle number 5 is to understand what you are investing in. Deborah Farrington, the founder and general partner of Starvest Partners, a New York-based venture capital fund, is all about understanding what you are investing in. And this is the strength of female investors. We may initially be hesitant to push the button on investing, but it's generally because we are uncertain and we don't understand. And we know we need to get financially educated and understand what we can do with our money before we will act. And so I say to you, take that action and get that knowledge and start investing. But understand fully what you are investing in. Don't be afraid to ask, and don't merely invest on the suggestions of your friends or family. Always make sure it is the correct investment for you. Success principle number 6. Believe in yourself. The grand dam of dividends, Geraldine Weiss, who is one of the most famous female investors in the world, was the first woman on Wall Street and considered to be the first to crack the glass ceiling. How did she do this? She believed in herself so much that she funded the publishing of her own investing newsletter with her own money in order to get taken seriously as an investment researcher in a very male-dominated investment world. She later penned her newsletter as the asexual G. Weiss. Having begun in 1966, she only started making profits on her investments in 1969, showing that perseverance and a strong sense of belief in oneself truly pays off. And the quickest route to self-action is self-belief. So do your research, get the knowledge you need, and get started investing. If you want to find out more things about investing, grab the Investing 101 How to Get Started Investing guide below in the show notes. If you like this video, please let me know by hitting like and share it with other ladies who want to change their financial story. And comment below if you found anything useful. For more financial talk designed especially for women, please subscribe to my channel. And I look forward to chatting to you in the future.